Good day, ma'am, and good day, everyone. My name is Angela Brandina from Bachelor of Science in Business Administration, major in Financial Management. We are the Group 5 to represent the financial intermediaries. So first, objectives. Objectives. Define the financial intermediaries. Differentiate depository financial institutions and non-depository financial institutions. Explain the role of different depository financial institutions and the non-depository financial institutions. Discuss the different risks faced by financial intermediaries in the socio-economic development of a country, and discuss in detail the economic basis for financial intermediation. Financial intermediaries. For example, surplus units are economic units whose income exceeds on goods and services. Conversely, deficit units are those economic units whose spending on goods and services is in excess of their income. This organization is created for a long-term service that create financial to sell to net savers, to raise funds, to buy or invest in organization instruments that sold by productive investors. It holds a very important role in the flow of money, and it is needed by the companies who want somebody to act as a middleman. So what is the meaning of middleman? Middleman means in raising money for investors. For example, if I buy goods from producers, then I will sell it to retailers or consumers. So this is what we call financial intermediaries. Second is the direct finance and indirect finance. First, direct finance is talk about personalized loan and interest rate. So you know how much can you spend at the dealership and apply for as many loans you want, like car loans, phone shops, paid loans, and etc. While indirect finance is a shop for loan packages from third-party lender, but the disadvantage for this is there's a possibility it may pay a little extra for convenience of indirect financing. Third, changing nature of financial intermediaries. First of all, the called changing nature is the old and new financial environment. The old financial environment was in the 1930s in the way of their traditional methods in producing goods relies rather than edge leveraging technology. It evolved from producing goods in the new financial environment. It was initiated from 2000 year was recommended solution for other components. FDIC or Federal Deposits Insurance Corporation to enhance financial needs. That's all. Thank you.
Good evening, everyone. I am Marita Kinabindit, the second reporter of this group, and my assigned topic is all about classification of financial intermediaries. So, financial intermediaries varied but they have one common characteristics. All of them issued secondary securities to be able to purchase primary securities issued by deficient units. And it has two categories. It is the depository institution and non-depository institutions. So I will be discussing the depository institutions. So it is the name implies refers to financial institutions that accept deposit from surplus units. They issue checking or current accounts, demand deposits, savings, time deposit, and help depositors with money market placement. And it has three kinds of depository institution. First is uncommon commercial banks. The second is deep banks. And the third one is rural and cooperative banks. So the commercial banks, it is perhaps the biggest of the depository institution. And commercial bank has two types of commercial banks. First is ang ordinary commercial banks. Kani siya nga bangko is gagrant lang siya og short-term loan. Then ang expanded commercial or universal banks is kuan siya. It is a combination of commercial banks and an investment house. They perform expanded commercial banking function, domestic and international, and underwriting function of an investment house. The second types of depository institution is ang drip banks. Drip banking system is composed of savings and mortgage bank stock savings, loans, and association, private development bank and microfinance drip banks, and credit union. First is ang saving mortgage bank. B. Saving and loan association. It is accumulate savings of their depositors, stockholders, and use these accumulated savings together with their capital for loans, and they grant and for investment in government and private securities. And the third one is on private development banks. It is catered to the needs of our agriculture and industry, providing them with reasonable rate loans for medium and long-term purposes. The fourth one is ang microfinancing drift. It is a small drift bank that cater to small, micro, and cottage industries, hence the term of micro. Ang last one is ang credit union. Ang credit union is cooperative organized by the people from the same organizations, whether formally or informally organized, like farmers, fishermen, teachers, employees, and so on. So, and the third one is rural and cooperative banks are the more popular types of banks in the rural communities. Their role is promote and expand the rural economy in an orderly and effective manner by providing the people in the rural communities with basic financial service. And that's all. Thank you.
Good day, everyone. I am Maria Lourdes Gamba, and I am the last reporter of Group 5 Financial Intermediaries. And I'm gonna report the non-depository institution. So, let's get started. So, I'm gonna report the non-depository institution. A non-depository institution is an entity that does not accept deposits. In non-depository institution, there are four kinds. The first is the insurance company. The insurance company is, example, the life insurance companies are financial intermediaries that sell life insurance policies. Like, for example, guys, the example of that is the BDO Life Insurance, the BDO Life Insurance Incorporated, the BPI, AIA Life Insurance, and so on. The second is the property or casualty insurance, or the insurance companies. These offer protection against pure risk. They insure against injury or property loss resulting from accidents, work-related injuries, malpractice, natural calamities, and add the extreme exotic adventure as trips to the wild. Just like an example, guys, in number 2, guys, the example of that is the medical bills, the pain and suffering. The pain and suffering refers to the pain and suffering that can be compensated as non-economic damages. The loss of wages, that it refers to the money you lost at work as a result of missing time to recover after an accident. The legal fees, that also known for legal expenses, the funding for legal representation and court costs, typically provided by the party or group which lost the lawsuit. So in insurance, there are 7 types of insurance. The first is the homeowners. The homeowners is a type of a property insurance that protects the home, furniture, and other possessions of an individual from losses and damages. Okay, so in addition to providing liability protection against mishaps in the house or on the property, homeowners insurance. The second one is the flood. Just like the flood is the specific insurance policy given to protect against property damages caused by flooding. The third one is the windstorm. The windstorm protects the policy holders from property damage brought on by gales, the winds, the hail, and other blustery dangers. It is a unique kind of property or casualty insurance. The fourth one is the umbrella liability policy. It is an additional insurance that extends the protection offered by other policies, existing limitations, and coverages. Coverages, injuries, the property damages, the specific litigation, and personal liability issues may all be covered by umbrella insurance. The health, like the Medicare, the Medicaid, and Children's Health Insurance Program, or the CHIP, and so on. The long-term care. The long-term care is the services for those who are unable to conduct daily tasks like clothing or bathing, including both medical and non-medical care. And the last is the professional liability insurance. Is the professionals including accountants, the attorneys, and doctors are protected by professional liability insurance or the PLI from client initiated allegations of negligence and other wrongdoing. So that is the types of insurance in that is the types of insurance. So let's move on to the fund managers. What are fund managers? A fund managers are among the fund managers are pension fund companies and mutual fund companies. So it is the fund managers are the accountability for maintaining precise accounting records for investment funds rest with the fund managers. In fund managers, there are two types. There are pension fund companies or the sell contracts to provide income to policyholders during their retirement years, and the mutual fund companies or they allow investors to purchase mutual funds that buy different securities in the securities market. So in pension fund companies, it is when an employee retires at the conclusion of their employment, the capital in their pension fund is used to pay them a pension. And the mutual fund companies is a corporation known as a mutual fund pools or the funds from numerous participants and uses them to buy securities like stocks, bonds, and short-term loans. The next is the investment banks, houses, or companies. It is the financial intermediaries that pool relatively small amounts of investors' money to finance large. So, investment banks, houses, or companies, it is an investment banking businesses or investment houses that are other names for investment banks in the Philippines. There are portfolios of investments that justify the cost of professional management. And the finance companies. The finance companies are profit-oriented, the financial institutions that borrow and lend funds to households and businesses. The finance companies are accepting payments in the form of deposits and loans. So let's move to finance companies. In finance companies, they had been traditionally grouped into three. The first is the sales finance companies, or to provide installment credit to buyers of big ticket items like cars and households appliances. The sales financing companies it engages whether by purchase, the discount, the pledge, the loan, or otherwise in the business of purchasing, investing in, or lending money or credit on the security of any interest in. The second is the consumer finance companies. The consumer finance companies is to grant small loans to individuals, generally those with low credit ratings and are unable to borrow from the regular lending institutions like banks and thrifts. And this consumer finance companies is a person in the business of lending money to people for personal, family, domestic, or other non-commercial purposes is referred to as a consumer finance company. And the last is the commercial finance company. The commercial finance company, also known as business finance companies, grant credit to businesses. So the commercial finance companies is a non-bank lenders known as commercial finance organizations offer loans to small businesses. In security dealers and brokers, it can be counted among other finance companies. They act as financial intermediaries in the same sense that they took for investors or saving units for the benefit of the borrowers of deficit units. So the securities dealers and brokers are a securities dealer, according to the SRC, is someone who buys and sells securities for their own account in the regular course of business, as opposed to a securities broker who does so for the benefit of other people. SRC 2000. Next is the pawn shops. Pawn shops agencies where people and some small businesses like pawn their assets as collateral in exchange of an amount much smaller than the value of assets. So the pawn shops is the personal loans that retail item resale and ancillary services like money transfers and cellophane activation are among ways that pawn shops generate revenue. Last, so next is trust companies and departments. It is the corporation organized for the purpose of accepting and executing trust and executing trust and executing trust and looking for trust. And so the I want to explain to you the trust companies and the departments are often a trust firm or department is a component of or affiliated with a commercial bank. So let's go to the risk financial intermediation. In a risk of financial intermediation is a risk is the possibility that actual returns will deviate or differ from what is expected. So, the first is the interest rate or the market price risk. It is the financial intermediaries perform what is known as asset transformation in their buying primary securities and selling secondary securities. An interest rate or market price risk is the possibility that a change in general interest rates will lower the value of a bond or other fixed rate investment is known as interest rate risk. The next is the reinvestment risk. A reinvestment risk is the risk that earnings from a financial asset need to be reinvested in lower yielding assets or investment because interest rates have fallen or decreased. So the reinvestment risk is the possibility that a change in general interest rates will lower the value of a bond or other fixed rate investment is known as interest rate risk. Next is the refinancing risk. Refinancing risk is the risk that the cost of rolling over or reborrowing funds could be more than the return earned on asset investment. So the refinancing risk is the likelihood that a person or business will be unable to refinance an existing debt, a crucial juncture of the borrower. The next is the default or the credit risk. It is the risk that the borrower will be unable to pay interest on a loan or principal of a loan or both. A default credit risk is the risk that a lender assumes in the event that a borrower won't be able to make the necessary payments on their debt obligation is known as default risk. The next is the inflation or the purchasing power risk. The inflation or purchasing power risk is the risk of increase in value of goods and services, reducing the purchasing power of money to purchase goods or services. The inflation or purchasing power risk is the danger that inflation will reduce the actual value of cash flows generated from an investment is known as inflation risk or purchasing power risk. Next is the political risk. It is the risk that government laws or regulations will affect the investor's expected return on investment and recovery or investment adversely or negatively. The political risk is the possibility that a country's political unrest or changes could have a negative impact on an investment's results. The next is the off-balance sheet risk. This is those transactions that do not appear in the financial institution's balance sheet but represent transactions that pose contingent if it does not actually exist currently but may happen in the future. The off-balance sheet risk is the contingent assets or liabilities like unused commitments, letters of credit, and derivatives are considered off-balance sheet entities. The next is the technology and operation risk. It is the advancement in technology poses an operational risk to all businesses, including financial institutions. This technology risk is any threat to data applications or information technology that has an adverse effect on businesses' operations. Businesses' operations. The next is liquidity risk. It is a result from withdrawal of funds by investors or exercise of loan rights or credit lines of clients, currency or foreign exchanges risk, or the possible loss resulting from an unfavorable change in the value of foreign currencies. The liquidity risk is the danger of suffering losses as a result of not being able to make payments on time when they are due or not being able to do so at a reasonable cost is known as liquidity risk. The country or sovereign risk. While investing in securities denominated on the other foreign currencies is advantageous for a financial intermediary, it is likewise posing a country or sovereign risk in investing in securities denominated in foreign currency. Just like the danger of financial impact or brought on by exchange rate variations is known as foreign exchange risk, sometimes referred to as exchange rate risk. And the last but not the least is the country or sovereign risk. While investing in securities denominated on the other foreign currencies is advantageous for a financial intermediary, it is likewise posing a country of sovereign risk in investing in securities denominated in foreign currency. So, a country or sovereign risk is the potential for a government to break one or more of its obligations, such as debt or the sovereign debt. So, that is my report for today's video.